Good morning everyone. Please come to this topic real option. We have already seen one question, number 1. Now we'll see the second question, which is based on abandonment option. Come to the abandonment option. What do you mean by abandonment option? Abandon option means you need not continue the project till its end. You can abandon the project before the last year also, if that option is available. For example, you can abandon the project after 1 year, 2 year, 3 year or 4th year also. This kind of option, if it is available in the project, is called option to abandon. Sometimes if you have the option to abandon, that will help you to save the losses. Instead of continuing the project, if you can abandon it, you will get more value. For example, if I continue, the present value of future cash flow is supposed to 100. If I decide to continue at the end of year 1, the present value of future cash flow is 200. But if I abandon it here, I may get a salvage value of 250. So what is better here? From the pure profitability point of view, continuation will give you 200. Abandonment will give you 250. So therefore it will be more appropriate to abandon the project. That is called project with abandonment option. Project with option to terminate the project before the maturity. Once funds have been committed to any capital budgeting project, it cannot be reverted without incurring a heavy loss. That is what they normally teach you at intermediate level or basics level, that once the project starts, it is difficult to reverse your decision except at a loss. But that is not necessarily the case. You can terminate the project in between and you can get a higher value. With abandonment option, the NPV of the project will further increase. However, in some cases, due to change in economic condition, the firm may like to opt for abandoning the project without incurring any further huge loss. So if I know, if I continue, suppose here, this is my 4th year, this is my 5th year. Future cash flow is 200. And I can terminate at this point at 250. Then it is better to terminate here and get 250 rather than wait for 1 year. Or the second example can be, this is my last year. If I continue, I will have a negative cash flow. But if I terminate it here, I can simply terminate it for 0 value. So what is better? Terminate it at the end of 4th year rather than continuing it up to the end of 5th year. So this will help us to reduce the losses, or indirectly it helps us to increase the profitability. The option to abandon the project is similar to American put option. And why we are discussing all this in the option chapter? Option to terminate is like American put option. That means you want to discontinue, you want to abandon the project, you want to terminate the project, you want to disinvest. So it is like American put option. That is, you can either terminate at the end of year 1 or 2 or 3 or 4, that is before the maturity, if the value derived from the project asset is more than present value of continuing the project for 1 or more period. So for the purpose of abandonment option, treat the option like an American put option. Treat that the project is like having an American put option embedded in it, and find the value of that American put option. That will give you a higher NPV value. Okay, if the option is there to terminate, the value of the project goes up, because you can either increase the benefit by abandonment or you can reduce the losses by abandonment. So let us solve one question on this. We also have problems on abandonment in the chapter Advanced Capital Budgeting. Okay. This chapter is more oriented towards valuation of option. In the advanced capital budgeting, it is more about decision making, whether to abandon or not, whether to terminate or not, whether to exercise the option now or later, whether to start a project now or later, whether to expand or not to expand, whether to replace or not to replace. This kind of decision making will be taught in Advanced Capital Budgeting chapter. For the time being, just let us see how to value the abandonment option in a capital budgeting project. IPL already in production of fertilizer. Question number 2. IPL already in production of fertilizer is considering a proposal of building a new plant to produce pesticides. Since the PV of the proposal is 100 crore without the abandonment option, however, if the market condition for pesticide turns out to be favorable, the PV of the proposal will increase by 30%. The PV of the proposal will increase by 30%. On the other hand, market condition remains sluggish, the PV of the proposal will be reduced by 40%. So you are at 100. It can go to 130, 100 plus 30%, or it can come down to 60, 100 minus 40%. So it reminds you of your risk neutral model. In case the company is not interested in continuation of the project, it can be disposed of for rupees 80 crore. If the company does not want to continue, it can be disposed of for rupees 80 crore. So this is like a put option. You can terminate the project and you will get 80 crore. So exercise price is 80. This is a put option. Exercise price is 80 and you will get 130. Would you like to terminate or continue? Please reply. If by continuing you will get 130. If by discontinuing or abandoning you will get 80. What will you prefer? 130 or 80? 130 or 80? Reply please. If you continue, you get 130. If you discontinue, you can discontinue at 80. What would you prefer? Continue or abandon? Continue or abandon? None of you are replying. I am not able to understand why. So the answer is continue. If you continue, it means you will not exercise the option. If you don't exercise the option, the value of the put option is 0. But if the market is sluggish, you will get 60 only. Whereas you can abandon the project at 80, which is like exercising your put option. So would you abandon or would you continue? Would you abandon or would you continue? So this time we'll say abandon. So value of the put option will be 80 minus 60 equal to 20. So if the market is buoyant, then favorable, you will get 130. If the market is sluggish, you will get 60. You can terminate the project at any time at 80. So therefore, if market is 130, we will continue. Value of put option is 0. If the market is 60, we will abandon at 80. The value of the put option is 20. If the risk-free rate of interest is 8%, what is the value of the abandonment option? So it is like finding the value of a put option. The same to same question you have done in case of risk neutral model also. So we will treat it like a risk neutral model and find out first the probability. Do you remember probability formula? R minus D upon U minus D. Find the probability, find the expected value of the put option on expiry and find the present value of the put option. So write down very important question for exam purpose. Option to abandonment is like put option and we have to find the value of that put option. So please write a note first. Please write a note. Don't directly solve. In this question, we have to find, the value of abandonment option. The value of abandonment option, that is put option. Then write down spot price is equal to 100. Spot price is equal to 100. Exercise price is equal to 80. Exercise price is equal to 80. Time is 1 year. Time is 1 year. Rate of interest is 8%. Rate of interest is 8%. Then write down decision tree showing the payoff. Step 1, write decision tree showing payoff. Decision tree showing the payoff. Under that you write down, you have 100 in year 0. In year 1, if the market is favorable, the PV of the proposal shall increase by 30%, which means 100 plus 30%. If the market is sluggish, the PV of the proposal will reduce by 40%. So it will become 100 minus 40%. This is 100 plus 30%. Payoff of the put option, write down here. Payoff of the put option, exercise price is 80. Payoff of the put option, exercise price is 80. So here put will lapse. Having an abandonment option is having a put option, and if you are getting 130 instead of 80, you will not abandon. You will not abandon means you will not exercise the put option, because you will get more value by continuing. Whereas if it is 60, put will be exercised. By exercising the put option, you are getting 80. By continuing, you would have got 60. So put gets exercised. And if put gets exercised, there is a benefit of 20. You get 20 more. You get 20 more. Is this diagram understandable? Is this diagram understandable? Now we have to find probability of value 130 and probability of value 60. For that we will apply the risk neutral model formula and it will help. Once we get the probability of 130 or 60, it means we have also got the probability of 0 and probability of 20. Then we can compute the expected value of put option on expiry and we'll take the present value. So write down next line. First we shall calculate First we shall calculate the probability of high demand. First we shall calculate the probability of high demand using risk neutral model. First we shall calculate the probability of high demand using risk neutral model. Under that, write down step 1. Calculation of probability that price will rise. Calculation of probability that price will rise. In bracket write, assume interest is compounded annually. Assume interest is compounded annually. If you want to assume continuous compounding, you can do that also. Whatever you do, you will write a note here. Looking at the institute answer, it seems they have applied annual compounding. Okay. So you can apply annual compounding or continuous compounding. Whatever you do, you have to write the assumption. Can't help it. Problem is only giving you 8% interest rate. Problem does not mention the frequency of compounding. So student has to write the assumption. Formula that we have learnt is P equal to R minus D upon U minus D. You have 100 at the beginning, interest rate is 8%, which means 100 after 1 year will become 100 into 1.08. 100 after 1 year with interest will become 100 into 1.08. And then if the price goes down, it is 60 minus 60. If the price goes up or the value goes up, 130 minus 60. This is what we have learnt. Kindly solve and give me the answer. Probability 0.686 is right. Very good. 685 is also okay. 6857 is also okay. Very good. 1 minus P, write down. 1 minus 0.686. According to your calculation, you write the answer. These are the probabilities of price going up and price going down. Same like binomial model. Now we'll write down step 2. Expected payoff at year 1. Expected payoff at year 1. This is the probability that the price will rise into value of put option. This is the probability that price will fall into value of put option. You can use risk neutral model for put option also, like this example. Okay, if it was a stock or an index, the same thing you will do for put option. Solve it now. You will get 6.28. Check the answer please. You will get 6.28. This is the payoff on expiry after a year. So now what I'll do, in order to find the value of the abandonment option, we will calculate present value. So you will write step 3. You will write step 3, present value of expected payoff. Please solve. Please try and solve. 6.28 divided by 1.08. 6.28 divided by 1.08. Rupees 5.81 crore. Rupees 5.81 crore. Rupees 5.81 crore. Write a note and complete the answer. The question is, what is the value of the abandonment option? That is, what is the value of the put option? The value of the abandonment option is rupees 5.81 crore. is rupees 5.81 crore. This answer is over. Any query? Any query on the previous question, Devika? Anup, any query? If you have no query, come to the next part, timing option. Okay, this is year 0, this is year 1. What you have studied in basics of capital budgeting, calculate NPV. If the NPV is positive, accept. If NPV is negative, reject. Am I right? This is what is taught in the basics. But wait, there is a third option also. Wait for some time. Wait for some time. That is, no need to start the project here if you are getting suppose negative answer. Sometime you will get more information if you wait. Like for example, suppose election results will be out after 1 year. Budget will be announced after 1 year, which will affect your business. Some negotiations are going on whose outcome can impact your project. Okay, future demand will be known if you wait for some time. Government policy will be known after 1 year, which may affect your proposal. So therefore, timing option means you need not start the project today. You have the option to start the project at a later date also. You have an option to start the project at a later date also. That is called timing option. Option to start the project at a later date is timing option, or also called option to postpone. I call it option to postpone. So therefore, there is a third choice in real life, that is delay the decision until later. That is option when to invest. So this is like call option. When to invest is like a call option. Why would you like to delay? You would like to delay because you are waiting for some more information. Your nature of the project is such that some future outcome can affect your project. So let us wait and see what is the outcome. Like you are an oil company. Right now negotiation is going on between the members of oil producing companies. They are called OPEC. Once the negotiations are done, either the oil price will be 120 or 80. If they decide to reduce the supply, price will rise. If they decide to increase the production, price will fall. So wait for a year and let us see. At 120 it is profitable for me, but at 80 it is not profitable for me. So I'll wait for a year, see the outcome of the negotiation, and if the outcome of the negotiation is that the price of oil will be 120, I will start the project after 1 year, because that will give me more profit. Same thing about government policy, budget announcement, election results, market demand, etc. So this is like having an American call option. That is option to invest at a later date. Option to invest at a later date in a project. It is called real option because it is not dealing with any financial product. It is dealing with a project, an asset. And when you have the option to start the project at a future date, then we'll call it American call option. And depending upon the data, we will solve either by risk neutral model or binomial model or by Black and Scholes model. So please come to question number 3. 3 questions are there in your book. This is the third question on timing option. Suppose MIS Limited is considering installation of solar electricity generating plant for Light the Staff Quarter, such a nice company. So the project is installation of solar electricity generation plant. So that is a real asset, not a financial asset. The plant shall cost 2.5 crore and shall lead to saving in electricity expense at current tariff by rupees 20 lakh per annum for a year. So if you start the project today, the cost is 2.5 crore and the benefit is 21 lakh rupees per annum forever, which is your perpetuity, annuity, okay. And somewhere below it is given the risk free rate or the cost of capital is 10%. The cost of capital is 10% means I will compute the present value at 10%. PV of infinite constant annuity, PV of infinite constant annuity is equal to 2.10 crores. Very good. Which means if I start the project today, my cost is 2.50 crore, but my present value of the benefit is 2.10 crore. So net present value is 2.50 minus 2.10, loss of 0.4 crore. So normally in your intermediate problem, it was asked up to this only. Basics of capital budgeting chapter will only give this much information. Cost of the plant is 2.5 crore, saving is 21 lakh per annum forever, cost of capital is 10%, please advise. And you would have advised that the project generates negative NPV, hence it should not be accepted. You are right, but sometime it is better to wait, okay. However, with the change in the government in the state, the rate of electricity is subject to change. The rate of electricity is subject to change. So this is like waiting for a year, let the election get over, party will change and that party will change the rate of electricity, right? Accordingly, the saving in electricity can be rupees 12 lakh or 35 lakh per year forever. So because of the change in the government, there are two possibilities. Either your saving in electricity will be rupees 12 lakh or the saving in the electricity would be 35 lakh. Assuming weighted average cost of capital is 10% and the risk free rate is 8%, decide whether this company should accept the project or wait and see. As far as accept the project today is considered, you should not accept the project. But what I'll do, I will also calculate the expected NPV if we wait for a year and see which government comes to power, and accordingly we will take the decision. Is it right? And accordingly we will take the decision. So write down the answer. Try in the notebook yourself, you will learn more. So there are two options you have. One option is you can start the project now. The other option is wait for a year and see which government comes to power and what is your saving in electricity, and then compute NPV in the two situation. Compute NPV in the two situation. Whichever gives you a higher NPV, that option you will exercise. That is the benefit of having an option to delay the project. So that is what we are trying to project now, that if you have an option, your NPV can be maximized. The project which is rejected can be accepted. So please write down option 1, start the project today. Option 1, start the project today. Then we will apply the formula of A upon R. The student should know this formula. If there is a perpetuity or annuity forever, the present value is equal to A upon R. In this question, savings forever means annuity is given 21 lakh and the R means cost of capital. You write here formula A upon R. R means cost of capital, or you can write K. Cost of capital, easy to understand. 21 lakh divided by 10%. 21 lakh divided by 10% is 2.1 crore. And what is my cost of the project? Cost of the project is 2.5 crore. Cost of the project is 2.5 crore. If I start the project today, the NPV will be 2.1 minus 2.5. 2.1 minus 2.5 is equal to negative 0.4 crore. Negative 0.24 crore. So would you start the project today? Say answer yes or no. Given this data, given this much information, the answer is no. NPV is negative. How can I start the project? Since NPV is negative, do not start the project. Basics of capital budgeting chapter, if you have studied in intermediate syllabus or maybe in some commerce colleges also they teach, they stop here. But when you come to final, one more option opens, and that is you can wait for a year and see what is the saving in electricity. That depends on which government comes to power, and accordingly the benefit will change. So now I will evaluate one by one. If this government comes to power, I will save 12 lakh. If this government comes to power, I will save 35 lakh. So what would be my NPV if the saving is 12 lakh? Because after 1 year, I will get to know exactly whether I am here or whether I am here. After 1 year is over, I will get to know whether this government comes to power or this government comes to power. If this government has come to power, what will be my NPV? If this government comes to power, what is my NPV? So write down, after 1 year, there are two possible situations. After 1 year, there are two possible situations. After 1 year, there are two possible situations. Either rate of electricity decreases, either rate of electricity decreases or increases. Either the rate of electricity decreases or increases. Or increases. If price of the electricity increases, if the price of the electricity increases, after the change in government, suppose the price of the electricity increases, the value of the saving forever will be, the value of this saving forever. Once you wait for a year, you will get to know whether I will save 35 lakh or whether I will save 12 lakh. So then I will do calculation one by one. If the electricity rate increases, my saving would be 35 lakh per annum and the present value is 3.5 crore. The present value is 3.5 crore and the NPV will be 3.5 crore minus 2.5 crore, that is 1 crore. 2.5 crore, 3.5 crore minus 2.5 crore, my NPV would be 1 crore if saving is 35 lakh rupees per annum. If saving is 35 lakh rupees per annum. And what is your rate of return? If I compare with my investment, I will invest 32.5, I will get a return of 3.5. So my rate of return will be 3.5 minus 2.5 divided by 2.5 into 100. Rate of return would be 40%. Rate of return would be 40% on the investment. Rate of return would be 40% on the investment. Now write down B. So there are two separate calculation I have to do. If the saving is 35 lakh, what is my NPV? If saving is 12 lakh, what is my NPV? So situation B, write down. If the price of the electricity decreases, suppose a government comes to power, it start distributing electricity free. You are thinking unnecessarily I have put the solar electricity plant. Your saving will be 12 lakh divided by 10%. In many state government, there is a competition to reduce electricity price or give electricity free. So 1.2 crore. The position of the NPV will be as follows. The position of the NPV will be as follows. So what would be the NPV now? What would be the NPV now? NPV would be now your saving is 1.2, but your cost of the project is 2.5. Saving is 1.2 and the cost of the project is 2.5. So this is 1.3 crore. This is 1.3 crore. So therefore your rate of return will be, you can write like this. If this helps you to understand, you will get 1.2 on an investment of 2.5 divided by 2.5 into 100, or you can write like this, whichever helps you to understand better. So here the return would be minus 52%. Return will be minus 52%. So if I have to draw a decision tree diagram, you will invest 2.5 crore. If the price of the electricity increases, you get 3.5 crore. If the price of the electricity decreases, you will get 1.5 crore. Your 2.5 crore can either give you 3.5 crore or can give you 1.2 crore. So this is what can happen after 1 year. Either you will get an revenue of 3.5, saving of 3.5 crore, or you can get a saving of 1.2 crore. So we need to find out the probability of this. We need to find out the probability of this. So write down, first of all, we shall calculate the probability of increase in electricity. We shall calculate the probability of increase in electricity using risk neutral model. As follows. Price can go up, price can go down. Accordingly, my value of the project can be up or down. So let us see what is the probability that electricity price will rise. Assume interest is compounded annually. Why I have taken annually? I am a follower of the institute. Whatever they will do, I will also do. Sir, can we take compounded continuously? Yes, you can, and accordingly write the assumption here. The answer will change by some rupees. Don't worry. So probability write down R minus D upon U minus D. R minus D upon U minus D. R means today 2.5 crore you will invest. The plant will cost you 2.5 crore. And if you invest it for 1 year at 8%, it will be 2.5 into 1.08. 2.5 into 1.08. 2.5 into 1.08. And if the electricity price goes down, this is the value. This is the present value of saving. If electricity price goes up, this is the present value of saving, and if the electricity price goes down, this is the present value of saving. So please check whether this calculation is right or not. Check whether this calculation is right or not. Yes, 0.652. If you look at the institute solution, please look at the institute solution in your book. They have done the calculation by using these rates. Sorry. They have done this calculation by using the rate of return 0.52% and what was that? 40%. That is also okay. You can take 1 rupee in your discussion as a starting number. It can go up by 40% or 1 rupee can go down by 52%. Your answer will be same. Your answer will be same. So both presentation is okay. You will say institute presentation is different. It's a matter of presentation only. But if you see, the final effect is the same. So please write down 1 minus P equal to. We are used to this format. If I keep changing the format, you will get confused. For probability in risk neutral model, I am continuously applying the same formula. Only I have done one change. I have taken annual compounding here, being a die-hard fan of the institute. Okay, so answer is 0.348. Now write down expected payoff after 1 year. Expected payoff after 1 year. Expected payoff after 1 year. What is the expected payoff after 1 year? If you wait for 1 year, if the electricity price increases, your payoff is 1 crore. If the electricity price decreases, your payoff is 1.3 crore. So my expected payoff after 1 year, is 19.96 lakh. Just check the calculation. If I wait for a year, I will get 1 crore rupees payoff with 0.652 probability, or I may get 1.3 crore with 0.0348 probability. So my expected payoff after 1 year, if I start the project after 1 year, expected payoff will be 19.96 lakh. And then we'll take the present value of this. This is after 1 year. This is after 1 year. Today's value, PV of the payoff after 1 year. Present value will be 19.96 divided by 1.08. This cash flow is at end of year 1. This cash flow is at the end of year 1. What is its present value? 18.48 lakh. If I start the project today, then the NPV is negative, 0.4 crore negative. If I wait for a year, the expected NPV is 18.48 lakh in present value term. So you have to compare now 0.4 versus 18.48. 0.4 versus 18.48, and therefore you will say it is not advisable to start the project now. It is advisable to wait for a year and see, because the expected NPV, if we wait for 1 year, is 18.48 lakh. Conclusion, write down. Conclusion: it is advisable to wait and see. It is advisable to wait and see. That is the answer, as NPV may turn out to be positive after 1 year. As NPV may turn out to be positive after 1 year. So this was a question on whether we should start the project now or whether we should wait for 1 year. These are some question on real option. More question on real option will be there in capital budgeting chapter. Okay. Thank you. Wait a minute.